Good afternoon. Welcome to our class today. Today, we want to look at financial accounting, a topic called financial statement analysis. Now, as we know that financial statement analysis are of two types. We use two methods. One is ratios analysis. The other one is statement of cash flow. So today I want us to check on statement of cash flow. And we're going to understand it from a solution from first paper that we did, that CPA student did in August 2024. August 2024, question 4B, they set a question on cash flow. So, cash flow, we have two methods of computing cash flow. One is the direct method, and two is the indirect method. And what is always recommended by International Accounting Standard number 7 is always the indirect method. So I'm going to solve a question to explain this final statement of cash flow analysis. The question you are seeing on your screen, as I read, you'll be seeing it on your screen, so watch it on your screen. Good. Now, let me read the question. Question 4B, that's of August 2024. They said the following are the financial statement of Precious Limited for the years ended 31st March 2023 and 31st March 2024. So you can see Precious Limited, statement of profit or loss for the year ended 31st March 2024. You can see the gross profit, you can see the amount, operating expenses, you can see. Then you can see operating profit, which is 4,650,000. Other incomes, you can see there's interest received, gain on sale of investment, and then less loss on sale of plant. Then there's interest expense paid, then there's net profit before tax. There's income tax expense, and then there's net profit after tax. You can also see the statement of financial position for the 2 years, 2023 and 2024. There's non-current assets. You can see their cost and also accumulated depreciation. Of course, the difference is the net book value. This investment, you can see the value of investment for 2023 and 2024. There's current assets, you can see inventory, account receivables, cash, prepayments, then total assets. Then liabilities and capital, you can see ordinary share capital. Then there's revenue reserve. Long-term liabilities, you can see there's bonds. Current liabilities, you can see accounts payables, accrued liabilities, tax payables, current liabilities, then total liabilities, and equity. Additional information. Precious Limited purchased investment worth shillings 11,700,000 during the year ended 31st March 2024. The company sold investment that had cost 13,500,000 for 15,300 during the year. During the year, a new machinery worth 18 million was acquired. Some items of property, plant, and equipment that had cost 1.5 million with accumulated depreciation of 300,000 were disposed of for 750,000 shillings. Number 4, included in the operating expenses for the year ended 31st March 2024 is the depreciation charged for the year amounting to 5,550,000. 5. The company issued bonds worth 15 million shillings at face value in exchange for plant asset on 31st March 2024 and repaid 7,500 of bonds at face value. Number 6. The company issued 2,250,000 ordinary shares at shillings 10 per value during the year. 7. The company paid cash dividends of 1.2 million during the year ended 31st March 2024. Required statement of cash flow for the year ended 31st March 2024 in accordance with International Accounting Standard IS 7 statement of cash flows. So now, you remember that cash flow statement, we are always required to, under indirect method, we are required to use we classify these activities into 3. We have the operating activities, we have the investing activities, and we have the financing activities. We have the financing activities like that. So now let us work on our workings. So these are our workings. So the first working, I'm going to run the PP account, the property, plant and equipment account. The PP account, the PP account, to see the cash that moved in PP account, the cash that moved in and the cash that went out, and the cash that was spent and the cash probably that came out. So if this is our PP account, our balance brought down, the opening balance, and the balances you can see in 2024. The balances you can see in 2024, which of course you can see there 2023, 75, 750. Balance carried down is 107 to 50. And then, of course, let's look at if there is any machine that was disposed or any machine that was acquired again. They said note number 3 that during the year machinery worth 18 million was acquired. So of course these things are truncated into thousands. So we are going to write here addition, which can also be cash. They spent that money, which can be cash, which would be 18,000 that was added. Then they say that some of the items of property, plant and equipment that had cost 1.5 million and accumulated depreciation of that amount were disposed of for that. So this disposal, you always credit because asset is reducing 500, 1500. And then I don't think there was in note number 5, they also say that the company issued bonds worth 15 million at face value in exchange of plant asset on that. So there was also cash that an asset that was added in form of bond, which was 15 million. So that is how, okay. So now that is probably all about this account for PP. So let's look at any change. Let's look at any change in any cash flow that came in that probably were added, that told us that they added a machine of 13. So with my calculator, let me see if I can close this account. So this is giving me 108,750. The credit side is 1500 plus 107 to 50. Also giving us 108,750. So the cash flow, the cash that was paid to acquire PP is that amount you can see, which is 18,000. You can see that account is balancing. The next working, let us also work out this other transaction that was associated with the machinery. I mean, with this PP, there's this issue of bond and also there's the issue of accumulated depreciation. Let's run accumulated depreciation as working two. Accumulated depreciation. So under accumulated depreciation, you can see the balance go down. Accumulated depreciation was 10,200. Then the balance carried down was 15,450. Now, they also told us in note number, the same note number 3, they said that there was a disposal. Of course, I can also run maybe disposal account. Disposal account. The PP disposal account. PP disposal account. So they said here that some items of property, plant, and equipment that had cost 1.5 million. So we disposed it here. Then we call it PP account here. It was 1,500 with accumulated depreciation of 300. So there is called accumulated depreciation of 300. Of course, once I credit accumulated the disposal account, I come and debit this account. 300. Then now, of course, there's also cash, the sales proceeds or cash. The deposits at a cash of 750,000. 750 here. So we're going to look at the gain or loss on disposal. The gain on loss on disposal. And then this account, the accumulated depreciation account will give us the depreciation charge for the year. The balancing figure in the accumulated depreciation account will give us the debt charge for the year. So this is 15,750. 15,750. So the balancing here, we call it charge for the year. Charge for the year. So minus 10,200. You get 5,550. That is the depreciation charge for the year. The disposal account is going to help us to read the disposal account is going to help us to look whether there was gain or loss on disposal. Whether there was gain or loss on disposal. So, of course, this side is likely to be more. 1,500. So, 300 plus 750, I think that's 1050. So 1050 minus 1,500, you get a loss of 450. So there's 450, which is loss on disposal. Now, when you come back to your question, you can see there is under in the statement of profit or loss, there's loss on sale of plant, which is 450. So this is how the figure was. We were arriving at the figure of 450. It's also an uncash expense. It's an uncash expense. So you're going to adjust it when you are adjusting those expenses. Now, there's another thing that is associated with the PP, which was bond. So let's run bond account. Bond account. Our bond account. So let me demarcate here. Our bond account. So this is going to be our working 2. Then this is our working 3. This can be our working 4. Bond account. Bond account. So, of course, it's a liability, so it has a credit balance brought down and a debit balance carried down. So bond, the opening bond was balance brought down for the bond was 36,750. Balance carried down is 44,250. 44,250. Then now they're telling us here that they also issued some bonds. They say here that the company issued bonds worth 15. So there was additional bond, so you can say new issue, but it was in form of PPE. So there was PPE that they exchanged for that plant, PPE, bond worth 15 million. And then we also had, they also repaid some bond. So they paid some bond in cash. So bond repayment. So there was a repayment of 7.5 million. 7.5 million. So let us see if that is going to work out. That 6,750 plus 15,000. Finding 51,750. 51,750. So let's also add this other one. 7,500. 7,500 plus 44 to 50. You also get 51,750. 51,750 in your calculator. So it means that this amount that they paid is cash. It's also cash. So cash paid to to sort out that bond, 7.5 million. Then now, let's run the ordinary shares account. We can now run the ordinary shares account, or we can check on note number 1. Let's deal with this non-current asset first and run investment account as our working file. Investment account. So investment account, you can see it on the balance sheet, the statement of financial position. There is investment account. Because it's an asset. No assets have debit balance carried down. Debit balance brought down. Credit balance carried down. So now, of course, our investment here. So balance brought down. Balance brought down for investment was 19,050. Balance carried down was again 17 to 50. Did note number 1, you can say that Precious Limited purchased investment worth 11. So there's addition, cost cash, 11,700. And then the company also sold some investment. So there was also disposal of some investment. And this investment that they disposed had cost 13,500. And of course, they sold it. So we can also run disposal account, investment disposal account, investment disposal account. Investment disposal account. Of course, if it's a T account, going to have balance brought down. Okay, not balance brought down, but let's just read disposal, which is investment account, which was 13,500. And then the cash proceeds. The cash proceeds from sale of that investment was 15,300. Was 15,300. So there was, let's look whether there was gain or loss on this disposal. Whether there was gain or loss of this disposal. So 15,300. 15,300. So there was gain of so 15,300 minus 13,500. Sorry, 15,300 minus 13,500. You get 1,800. 1.8 million. 1.8 million. And then if you come back to your profit and loss account, you can see that there was a gain on sale of investment worth 1.8 million. So that's how you are getting it. And now let's now find the balance the investment account to see what happened. So now here they're saying that 19,050 plus 11,700, you get 3750. 3750. What about the debit side? The credit side, 13,500 plus 17 to 50. You get again 30,750. So that means that the cash that they paid to acquire that investment was 11. This was working 5 and this was working 6. So if we proceed with these T accounts, we can now run. We're done with investment. So this we also have got the working capitals here. Working capital. This one we don't need to run the account. We just show them as we answer because they just show movements of cash equivalents. They just show movements of cash equivalents in the in the balance sheet or in the working capital. So we can run our ordinary share capital account, ordinary share capital account, ordinary share capital account. So here again we are going to look at how this is equity. So it has a credit balance go down. So we have got balance go down of 47 to 50. The balance carried down of 69,750. So of 69,750. Now we can see it there. So then the balance, there's note number 6. They say the company should gain additional shares of 2,250,000 ordinary shares at 10 shillings per share or per value. So new issue. So we can just do it here, 2250. That was number of ordinary shares times 10 shillings, which was per share. We're going to get 22,500. 22,500. So if we balance off that account, let's add it out to see how it's going to. So 4750. My calculator is interesting here. 47 to 50 plus 22,500. So you're getting 69,750. 69,750. 69,750. So now it means that the new issue came in form of cash. So that was cash received from issue ordinary shares, because you can see that account is balancing. Next thing here is ordinary dividends. Ordinary dividends. So in ordinary dividend, we can run the revenue reserve account. So if this is our working 6, working 7, working 8, we do the ordinary, the revenue reserve account. Revenue reserve account. Revenue reserve account. So we process also equity, so balance go down with this side. Balance go down was 19,800. Balance carried down, which was 1,000. Again, then there was the profit for the year. We can also look at profit for the year. That's profit after tax. So then we can solve it P&L account. P&L account, which was in the question, you can see it was 2,400. 2,400. Then there was dividend. They say they paid us dividend. Dividend paid. Dividend paid. In that case, in note number 7, it was 1.2 million, so it can be 1,200. 1,200. So let's try to balance again of this account. So 19,800, 19,800 plus 2,400. So here you get 22,200. Then 1,200 on the debit side plus 21,000. You're getting 22,200. So we have seen how those figures they found those figures, because you must know how they arrived at those figures. So again, what is there that we have not checked is the tax payable. Let's look at the accruals. If there was accruals, they're saying there was accrued liability, and accrued liability, of course, was there anything that was accruing in the question? So it's just going to be one of the cash equivalent, because I don't see what was accruing. Because the interest was paid, and then there was interest that was received. So there's no accrued liability. So it's just, so let's now run the tax account. We can run our tax account and see. So tax account or taxation account. Taxation account, which is our working 8. Can be working 9 now. 9. So tax cost liability, tax payable, which was for 750, and then balance carried down for tax was amounting to 450. Means they paid some cash, some tax. And then P&L account and the profit and loss account, you can see that income tax was 1050. So P&L account was 1050. And now they did not tell us any amount of tax that was paid. So this is where you're going to get the amount of tax that they paid. So they really paid a lot of money to carry. So 750 plus 1050, get 1,800. So tax paid minus 450, get 1,350 here. 1,350 is the amount that was paid, tax that was paid. I don't think there was much that's remaining. We're just going to look at the other cash equivalent. So let's quickly post it. Give its financial statement, the cash flow. So let's now solve it. They ask us to solve it now. So here we are going to have the heading of the company called Precious Limited. There's Precious Limited. Statement of cash flow. For the year ended 31st March 2024. So after you've written your heading, then you start classifying these activities. So you can write your shillings in thousands, shillings in thousands. So now we are going to have cash flow from operating activities. Cash flow from operating activities. We always start with profit before tax. Profit before tax in this case was 3450. 50. Then we look at adjustments. Adjustments, we look at those items that were non-cash in nature. Then we adjust items that were non-cash in nature. So the first and those items must have appeared before profit before tax in the income statement. So the first one is depreciation. It's always non-cash expense. Depreciation. So depreciation is working. We found it in working too. It's also one of the expenses that were non-cash in nature, though they were deducted. We're finding it to be 50. Like that. Then there was gain. There was this gain on disposal of investment. It's non-cash income. Gain on disposal of investment. We did it in working 6. But again, you can also see direct there, they gave us to be 1800. So it was non-cash income, we deduct it. Then we also saw the issue of there's loss on disposal of plant. We did it, but you can also see it was 450. So you add it's a non-cash expense. I think those were the adjustments that we had. Those were the non-cash items that we had. So let's adjust them. So let's adjust them by writing here 50 minus 1800 plus 450. So we get 4200. So after doing that, then the answer you add it to the profit before tax. The answer you get is what we call cash flow before changes in working capital. Before changes in working capital. So that answer plus 3450 get 76 50. 7650. Then let's look at changes in working capital. Changes in working capital. Changes in working capital. So from there we can look at increase in these working capital items. Can start with under current assets. I can start with increase in inventory. Inventory increased, so there's increase in inventory. So anytime inventory increase, of course, it shows that cash was going out because you're buying more stock. So 21,600 minus 16,500. So means that you're buying more stock, so it's going down. It's reducing 16,500. So you get 5,100. Then there was account receivables. I can also see it decreased. So decrease in accounts receivables. Accounts receivables. Account receivables. You can see it was again 7050 minus 8250. So that means that our debtors were paying. Our debtors were paying, so it means notionally cash was coming in. So you add it. Then there was this prepayment. You can see prepayment reduced, decrease in prepayment. You know, prepayment is you pay things in advance, expenses in advance. So when you see it decreasing, that means that you are not making more prepayment. You're not making more prepayment. So it was 150 minus 750. 150 minus 750. So it means either we are saving more cash, 150 minus 750, or we are retaining more cash, so 600. You add it because we're decreasing. And then we add, when we come to account payables, you can see it also decreased. Account payables increased, sorry, account payables increased. Account payable, so decrease, sorry, increase in accounts payables. When account payables increase, you will deduct because it means that you are not paying your dues, so you are retaining more cash to the business. So you're going to have a positive inflow of cash. So 7,500 minus 6450. So 7,500 minus 6450, you get 1050. 1050. Then those accrued liabilities, which also increased. So increase in accrued liabilities, let's say accruals, which was 1,800 minus 1,350. So it means that these people are not paying. They're not paying their dues. They keep on accruing them. So they're saving some cash. So you add it for 50. So that is our working capital. So let's start solving it. Let's now check on solving. So for 50 plus 1050 plus 600 plus 1200 minus 5100 minus 5100. So you get negative 1800 here. You write it in this column, 1800. So then the answer you get, if you add this the cash flow before changes in working capital and also changes in working capital, you get what we call cash flow after changes in working capital. So that one plus 7650, you get 5850. So then after that we can look at the other payment, which was tax paid from operation, tax paid. Tax paid was in our working taxation account, was in our working taxation account. I think it was on this working 9 taxation account. Tax paid, could see it was coming to be 1350. So 1350. So the answer you get there is tax paid, net cash flow. Net cash flow operating activities. Net cash flow from operating activities. So 5850 minus 1350. Answer you get here is 4500. So that is our net cash flow from operating activities. It's always one of the somehow complex one. It involves many things because operations deals with the daily activities of the business, unlike investing activities. So after that, then we go for cash flow from investing activities. There's cash flow. There's cash flow from investing activities. Cash flow from investing activities. So this is investment, the issue of also acquisition of PP, investment, and the rest. So we can start with cash paid to acquire PP. This can be our first cash flow from investing activities. Cash paid to acquire PP. Of course, it's not number one, and also we found it in our workings. We found it out in these workings. Working 1, that cash paid to acquire PP was 18,000. So because it was cash went out, we must show that cash was moving out in parentheses. Now, the next is there was also even investment. There was investment that was also bought. So cash paid to acquire investment. To acquire investment. It was 11,700. Also cash moved out. Then we have cash paid, cash received from sale of PP. There was a PP that was disposed. It was disposed for some cash. Cash paid to acquire PP. They told us it to be 750. Then also cash received from sale or disposal. Investment. Disposal of investment. You can see here it's turning out to be investment. It was 15,300. It was 15,300. So I think we are done with investment. There's no other investment that was remaining. So we can get cash flow from net cash flow from investing activities. So let's work it out. Net cash flow from investing activities, 18,000 plus 11,700. Okay, negative 18,000 minus 11,700 plus 750 plus 15,300. So we have 13,650 negative. The amount of cash that went out through investment is 13,650. Then we have got cash flow financing activities. From financing activities, and you can see cash flow from financing activities. You can see it here. The first one is cash received from issue of ordinary shares, ordinary share capital, or ordinary shares, which we found to be now working 7, cash working 7, which was 22,500. 22,500. And then there was also cash paid, okay, cash bond repaid. There was also bond that was repaid, which was 7,500 bond. You can see our bond account here. So it was indicating that they made a repayment of 7.5 million. So money went out. So you must show that cash went out. And then there was dividend paid. Dividend paid, which was 1,200. So from there we can get net cash flow from financing activities. Net cash flow from financing activities. So there we go, 22,500 minus 7,500 minus 1,200. So you get 13,800. 13,800 as our net cash flow. So we are closing the chapter by saying that let's look at whether our question is balancing. So then we say cash and cash equivalent, cash and cash equivalent for the year. So we're going to add these three: the net cash flow from operating activities, from investing activities, and also from financing activities. So we have got the end of operating activities, net cash flow from operating activities. You can see it's 4,500, which is positive. 4,500. From investing activities was negative. You can see it here, negative 13,650. Then from financing was 13,800. That's 13,800. So if you add that, you work out that one, going to get 450. 500 minus 13,650, and then plus 13,800. 13,800, you get 46,50. Get 46,50. 650. Then cash equivalent. Cash and cash equivalent. Balance carried down, brought down. Opening balance, which was, you can see in the question, it's coming there to be 22 to 50. 22 to 50, which is positive. Then if you add it, it should give us cash and cash equivalent. Cash and cash equivalent balance down. So let's add the two. This added that one, I add to the balance for down, which is 2250. we get 6,900. 6,900, which is our cash. 6,900, which is our debit, which is our balance, the cash and cash equivalent, which you can see it's 6,900. So this means we are correct, because the answer we get after adding the cash and cash equivalent for the year plus the cash and cash equivalent for the previous year, we're supposed to get the same as what was there. So you can see 6,900 or 6,900,000, and also you can see our cash and cash equivalent of 69,900,000. So this means we have done the question correctly. We've done the question correctly. Thank you. Bye. Let's see each other in our next video. Bye.